It is true that gold and oil will never flow in the same direction. It is also true that if the flow of gold stops, the economic engine of the world will seize up. In a previous video titled, "When Gold and Silver Go into Hiding," I presented this mechanism whereby a pseudo-gold-backed currency is created and used to pay the world's economic powerhouses, such as the oil-producing nations. It is this mechanism that ensures that the gold flows where it needs to flow. I've gotten a lot of questions about the content of that video, and it made me realize that I need to take a little bit more time on some of these concepts. Before I do, I would like to say thanks to Brother John F. for posting my video on his website and for his kind words. I've followed his excellent work now for a couple of years, and I'm very humbled that he's referred people to my channel. But now let's talk a little bit more about the importance of the flow of gold and its impact on economic activity. As I've stated before, Big Oil has made it clear their desire to be paid in gold in return for selling their depleting treasure to the West. But if oil were to be bid for gold directly, the price of gold would skyrocket and both gold and oil would stop flowing. They learned that the hard way in the 70s. And so, they now get their gold by purchasing future mine supply. But there has to always be some above-ground physical gold backing to guarantee the delivery of future gold. Here I've changed my diagram to an animation to make things a little easier to visualize. You can see how oil, gold, and currency flow through this system at any point in time. We have at the top the oil exporter who accepts dollars in exchange for producing oil. That oil exporter sends dollars to a bullion bank, who in return provides futures contracts for the supply of fine gold. Gradually, these futures contracts are exercised, and so real physical gold will flow from the bullion bank to the oil exporter in the present time. The bullion bank must get this gold from somewhere. It is true that the bullion bank supplies dollar loans to mining companies to fund their operations, but the mining company, when it funds a new project, can only agree to supplying gold in the future in return for present cash. So where does the physical gold come from that the bullion bank supplies to the oil exporter in return for dollars? That's right. It comes from gold loans. Real physical gold is supplied to the bullion bank on a temporary basis, and I need to emphasize the word temporary here because the suppliers of the gold want it back, with interest. Thus, the economic elite of the world, those who own the gold, mobilize that gold on a temporary basis to fund real economic activity. It is these gold loans that keep the economic gears of the world turning. Let's discuss the nature of these gold loans, because it will shed some light on how real physical gold is still used as the world's money, even though most of us are unaware of it. And unaware of it is how the world's elite would like us to stay. For, if the common man became aware of just how valuable gold is to world commerce, we would buy it up, and it wouldn't be as easy for the planners to direct the flow of newly mined gold to where it needs to flow. Gold is funny that way. It tends to dry up as the price increases. Hopefully that little animation helped to illustrate how the system as a whole works. Let's discuss the gold loan in more detail, which is how real gold is mobilized to fund economic activity. In my simple illustration, I showed the source of the gold as a box titled Monetary Authority. This was a little too simplistic. In reality, that box contains the source of all monetary gold, whether it is from a central bank, from a government treasury, or from a very rich and powerful family. We can speculate about whether or not the rich and powerful families of the world actually have title to the gold that's held by the central banks, but since it's not necessary to this discussion, I'll leave that topic for later. So what is the motivation behind lending gold to the market? Obviously, if an individual, family, or group owns any gold, then they place a high value on that gold. Otherwise, they wouldn't own it in the first place, right? So why do they want to lend it to the market? Well, the answer to that question is to generate a return. We're often told that gold is a stupid thing to hold because it generates no interest. That's just not true. The masters of the metal know how to create an income from it. They know how to make it sing. In a nutshell, here's how they do it. Here's a graph of the prices of futures contracts as well as the spot price of gold as they stood at the end of the day on January the 1st, 2013. Suppose you're a big holder of gold and you would like to make it earn some interest for you. The first thing you do is sell 100 ounces of gold at spot to receive $120,515. Why 100 ounces? Well, that's the size of a single futures contract. You can sell more if you like, but this will serve for the sake of my illustration. Now, you could certainly spend your $120,515 on consumable items, but that's not your goal. You want your gold back, plus a little extra cash to compensate you for lending your gold to the market. So the next thing you do is to buy a futures contract for delivery of gold back to you at some point in the future. Generally, the lenders of gold pick 1 year or less, so let's pick 1 year. Currently, the CME requires that only $8,800 be used as payment for a futures contract. This is the minimum margin requirement. Obviously, putting down the minimum margin puts you at risk of a margin call if the price of gold drops before expiration. But there are ways to hedge that risk. You could always put down more cash, or you could buy a put option on gold. So let's assume for now that you do put down the minimum, just for the sake of this example. Now you've just spent $8,800 of the $120,515 you received for your sale of gold at spot. This leaves you with $111,715 to put to work for you. And this is done in the paper market. So now let's calculate what kind of a return you would need to generate in the paper market to make this system work for you. Your futures contract costs you $120,570. You put down $8,800, so you'll need to pay $111,770 at the end of the contract in order to get your gold back. This is a little simplistic because I'm ignoring the cost of hedging options, ignoring spreads, and ignoring the clearinghouse mechanism that continuously transfers cash as the price of gold fluctuates. But I'd like to keep things simple just to illustrate the main concept. So let's just keep it in mind that we'll need $111,770 at the end of this contract to get our gold back. So you know that you'll have $111,770 due in a year, and you have $111,715 to work with. This means that if you can just generate $55 worth of income, then this operation will be profitable for you. Now bear in mind that I'm dealing with the futures curve as of January the 1st, 2013, which is atypical. Under normal conditions, the amount of profit that we'd be requiring would be much higher, but I'll get to that in a minute. Now you need to generate $55 to cover your costs, and the general interest rate on 1-year money is 0.6%. So you lend your cash at 0.6% for 1 year, and it generates $670 worth of interest for you. Subtracting out your $55 spread on gold leaves you with a profit of $615. So now you see how gold can be used to generate interest, and this is what's actually done. Now $615 is not much incentive to lend out 100 ounces of gold. I will absolutely agree with you on that point, and this will be important to keep in mind for the remainder of this discussion. But before 2008, the amount of income that could be generated from gold was much, much higher, and thus the incentive to keep gold in circulation was also much, much higher. Okay, last slide using this futures curve. Keep in mind that the spread between the futures price and the spot price is the cost to the gold owner of mobilizing investment-grade gold for the sake of making a profit. At the same time, everyone's cost is somebody else's profit. The spread that the gold lender pays is the profit margin of the bullion bank that compensates for providing warehouse services and for making the market. Typically, the spread on gold futures in the near term is 2 to 6%, not the near zero spread that we see here. So right now, the cost of mobilizing gold is very, very low, as is the profit that can be made by the bullion banks for acting as the intermediary. In fact, in the very near-term contracts, the cost of mobilizing gold is actually negative. Think of the implication of this for a minute. In a nutshell, it means that someone would very much like for you to mobilize your gold. They are willing to pay you a completely risk-free profit in order to borrow it from you. In other words, gold is not flowing right now. If it was, then there would be much more gold out there competing for dollar loans, and the futures curve would be much steeper. Now that we've discussed gold loans in more detail, we're ready to have a little fun looking at trends and seeing what they are telling us. What I'm showing you here is the gold forward offer rate for various gold loans as provided by the LBMA on their website. For those of you who don't know about the LBMA, it is an association of bullion banks who specialize in making gold loans. If you have some time, you should research them on the internet. The Gold Forward Offer Rate, or GOFO for short, is the cost of dollar loans that are collateralized by gold. It is really just the spread of the futures curve that I showed you on the previous few slides. The LBMA tracks this measure because it is very central to what the bullion banks do. You can see that since 1989 the GOFO has been trending down. How should we interpret this? Well, it tells us a couple of things. First, paper currency is becoming cheaper because the interest rates for even unsecured loans has been trending down over this time period. Second, gold is not bidding for dollars as actively as it once did. More on that in a second. The very important features on this graph, though, are the points when the GOFO went negative. These are extremely important points because it is an indication that gold has gone into hiding. Let's discuss one incident in particular, which is the prominent spike negative in September of 1999. This spike negative was really a shock to the gold derivatives world. In an announcement made on September 26, 1999, the central banks of Europe, who accounted for 45% of the world's global gold reserves, announced their intention to limit gold sales and, more importantly, to not increase their lending of gold through the gold derivatives market. It was a signal to the market that the Europeans wanted to give gold a much larger role in world finance. Here's the text of the announcement. Quote, "In the interest of clarifying their intentions with respect to their gold holdings, the above institutions make the following statement. 1. Gold will remain an important element of global monetary reserves. 2. The above institutions will not enter the market as sellers with the exception of already decided sales. 3. The gold sales already decided will be achieved through a concerted program of sales over the next 5 years. Annual sales will not exceed approximately 400 tons and total sales over this period will not exceed 2,000 tons. 4. The signatories to this agreement have agreed not to expand their gold leasings and their use of gold futures and options over this period. 5. This agreement will be reviewed after 5 years." End quote. And it has been reviewed every 5 years. Each time, it was renewed. And this did create quite an emergency on a global scale, requiring some drastic action on the part of the Bank of England and the New York Federal Reserve. Here is a statement made by the Bank of England Governor Eddie George to Nick Morrell, the CEO of Lonmin plc. Quote, "We looked into the abyss if the gold price rose further. A further rise would have taken down one or several trading houses, which might have taken down the rest in their wake. Therefore, at any price, at any cost, the central banks had to quell the gold price, manage it. It was very difficult to get the gold price under control, but we have now succeeded. The U.S. Fed was very active in getting the gold price down." End quote. So we can see that a negative GOFO is a very significant event that signals that gold has gone into hiding. We can also see that when gold goes into hiding, it creates a very real emergency for central planners. In other words, gold is absolutely essential to world finance. We shouldn't let anyone try to convince us otherwise. And now, to see where we're heading, let's take a close-up look at the GOFO rate from 2008 onward. You'll notice that after the Lehman collapse, the cost of mobilizing gold has been very low, and recently has gone negative several times. And these negative episodes are not the temporary spike lows that we've seen in past emergencies. These are sustained negative events. I believe that just as happened in 1999 when the Bank of England sold England's gold at a record low point, today's central planners are taking desperate measures to mobilize the world's gold. But as you can see, the world's gold is not flowing. It's not bidding for paper currency as it once did. Part of the reason is that there's just no profit available to the holders of gold for making it available to the world. Part of the reason is that there's some concern over the return of that gold. We should concern ourselves over what will happen when all GOFO rates go negative and stay there. This will mean that the gold has stopped bidding for dollars altogether. This is the point at which the futures markets will break. This will result in the petrodollar losing its world reserve currency status. The world will likely go into a deep depression unless and until a reasonable substitute is found that can remobilize the world's gold stores. Unfortunately, this will create a problem for us gold investors. Aside from the temporary inconvenience of a world financial system that has seized, the signals coming from the futures market won't be valid. We won't know how to value the gold that we have in our hands. It's possible that one day we will wake up and the spot price of gold will suddenly be over $10,000, perhaps well over. It's also possible that we may wake up one day and find that its quoted price has plunged to near zero. We should mentally prepare ourselves for this possibility. The valid pricing signals will probably come from the physical exchange being established in Shanghai. In the meantime, friends, please keep your eyes on the GOFO rate. It is telling us that gold is going into hiding, and that is a very telling and disturbing sign.